Happy New Year, everybody. I'm Stacey Perkins, Vice President of Global Marketing for Legacy Education Alliance, and I'm happy to bring you 2017's first edition of Legacy Connection. Your connection to Legacy's most shared and engaging content for the month of January, spanning from real estate and foreclosure investment to financial markets and currencies across the globe. It's so great to be with you in this new and exciting year. In this month's edition, we're discussing the current state of the market in the wake of recent interest rate fluctuations and the investment entities or asset classes that you should be focusing on as a result of said activity. We will once again be joined by Legacy Education Alliance's CEO, Anthony Humpage, and financial expert, Mark Justice, and we'll leave you with a motivational quote to help keep you inspired for the remainder of the month. Let's get to it. On the eve of the presidential inauguration, it's worth going back to some of the key points that President-elect Trump made on the campaign trail. One of the issues that Mr. Trump took a stance on was tax rates, as promised to massively cut taxes for the middle class as well as for corporations. Assuming he makes good on his promise, we will need to be financially prepared for the shift. And who better to set us off on the right path than Legacy's very own CEO, Anthony Humpage. Anthony?
Mr. Trump has said very bluntly that he's going to cut tax rates, both corporately and personally, which is a good time for me to remind you that you really should speak to your professional advisors, your lawyers and your accountants, on the entities that you plan to use to conduct your investing activities. Because making the wrong entity choice can be quite expensive in terms of unnecessary taxes that you'll have to pay. And for those watching me overseas, this is true everywhere. It's true in England, Europe, South Africa, Hong Kong, Australia, and New Zealand. The entity decisions you make are very important. But back to the US, we know that Mr. Trump, as we just referred, has said he's going to cut taxes a little or a lot, but he's also going to spend more, notably in large infrastructure projects, which is almost a second form of financial stimulus. However, with taxes going down and more money being spent, that money's going to have to come from somewhere, and it's going to be deficit spending, which means debt will go up. Now, over time, this is going to push interest rates up. We've seen it start already in the 10-year bond and the 30-year bond, where bond yields have risen as much as 50% since the election, forcing bond prices down. What's the take-home from that? Well, if you're thinking of borrowing money, I wouldn't be putting it off. This isn't going to be an overnight change, but things always take longer than we think they're going to. So starting to build up your leverage now would not be a mistake, in my opinion.
Thank you, Anthony. As our CEO reminds us, seeking out professional advice and educating ourselves on which entity choice to invest in as a result of impending tax cuts can be the difference between small or large and unnecessary tax payments. As Anthony also explains, these cuts, coupled with increased spending, will raise the national debt and thereby pushing interest rates up. In other words, the time is ticking for leveraging your debt. So in light of this new information on the interest rate activity that is to come, exactly which asset classes or entities should we be investing in? Well, it just so happens that we caught up with our very own financial expert, Mark Justice, on the latest edition of Investing Talk Live, a day after the Fed convened, where he gave us a little hint. Let's listen in.
The market, as a general rule, does not like it when the Fed raises interest rates. Does not like it for numerous reasons, but it is adverse to the Fed raising interest rates. So two things will happen. It's expected the Fed will raise interest rates tomorrow. That's expected. You might say that's already been priced in despite the upward movement you've seen. But if they come out in their statements and say, in this coming year, in 2017, we expect a more aggressive interest rate raising, well, that might put a halt. That might be the catalyst that causes a side trend to develop in the overall markets. We don't know. if you knew, if you had perfect knowledge. But once again, I have to reiterate, it's a known event. If you have short-term positions, you should be aware of this happening tomorrow.
Thank you, Mark. A couple of things that Mark said that jumped out to me were adverse market reaction to high interest rates and short-term positions. I'd like to quickly reference one of our latest blog entries on My Elite portal titled, "What are my options for investing?" In this article, we discuss different asset classes. Here, we point out that one of the safest entities to invest in are money market assets. Not only are they highly liquid, but usually they have a term of only 1 year or less. So in a market environment that isn't exactly optimal, speak to your financial trainer about investing in low-risk, short-term assets. As we come to the end of this edition of Legacy Connection, I'll leave you with one of my favorite quotes that we shared in 2016. "It's not what you look at that matters, it's what you see." Such a powerful message, reminding yourself to apply that entrepreneurial filter to your everyday life. That sense of optimism, drive, and can-do attitude to everything you encounter will only make you a better version of the person that you were yesterday. Apply that filter. Start now, and over time, it will become a part of you. I'm Stacy Perkins with Legacy Education Alliance. Thank you so much for watching, and we'll see you next time on Legacy Connection.